C, we deal with buyback securities. The share capital what you issued, you can purchase yourself. Usually preference share can be purchased, which is called redemption. Debenture can also be purchased and cancelled, called redemption. But equity share capital rarely done, which is called buyback shares. See, I'll give a structure here, you will understand that's more than enough. Buyback shares. How many shares you plan to buy back and its face value. Its face value. Are you paying more than the face value or same? If you are paying more, it's loss. That is called buyback premium you pay. Buyback premium. This is the amount you have to pay. How can you pay this? How can you buy back? Okay. Now, buyback can be done by proceeds from fresh issue. Proceeds from fresh issue. Or transferring free resource to capital redemption resource. These are the two methods we have. Remember, what is called proceeds and what is called issue. Fresh issue of shares. Fresh issue of shares. Okay. Any share. Equity share as well as preference share. If the face value being 10, issue price is 10, then proceeds being 10. Face value 10, issue price is 12 at premium. In that case, your proceeds be only 10. Means profit excludes the premium. Profits excludes the premium, number one. Always remember the amount transferred to free resource to CRR and adding the amount of profits with that, it should be equivalent to the nominal value or face value of the buyback shares. This is condition number one. Condition number one. Face value of buyback share should be equivalent to proceeds and CRR created. Clear? That's all. Second one is all about fundraising. To buy back, do you have cash or not? Fund requirement. What is the requirement? Cash required for buyback. For buyback. Minus any balance you have. If nothing stated, you assume the cash balance you have. Cash and bank balance you have. That's how you can assume. Cash and balance cash. And amount collected. Collection from issue of shares, full issue, it's not profits, full amount collected. Okay. And if there is any shortage, that shortage amount can be borrowed or issued debenture or sale asset, sale of assets. This is possible, rarely. So you have to understand this structure, that's all. Let's see. For this journal entry number 1 is for this one. For the issue of shares, what is journal entry? Bank account debit to share capital, equity share capital. If you collect more than its worth, then securities premium. Par means only equity share capital. This is the entry number 1 for issue of shares. Entry number 2 is for Due entry payable to the owners. Equity share capital account debit. Are you paying the same value or more value? More value means the excess amount is called premium on buyback to equity shareholders. This is the due entry. Third entry, make the payment to them. Equity shareholders account debit to bank. We made the payment. Fourth entry, if you are paying more, this will be loss. This loss will be adjusted to your profit and loss account or free resource. Free resource is nothing but profit and loss, general reserve and all will be called as free resource. I will give the list then. Free resource account debit to buyback premium on buyback. This loss is adjusted. Premium on buyback. Okay. Now, if you are supposed to create the CRR from the free resource, the journal entry for this being free resource account debit to CRR, capital redemption reserve. This CRR is named as capital redemption reserve. Clear? Only 5 entries you have to understand. Our 6th entry, suppose if you borrow, entry for borrowing or sale, entry for sale you need to pass. Only these are the set of entries you need to know for the buyback. Very simple. In buyback of shares, 2 aspects are there. Amount payable for the buyback, for that journal entry passing is one aspect. Another one being, all the equity shares cannot be bought back. Then how much can be bought back? That's a limitation. Within that limit only you have to buy back. So, sometimes you may be asked what is the maximum permissible limit for buyback? That question. Another question is, buyback and do the entry for passing buyback related transactions. This topic 50% is over. That's all. 50% is over. It is clear. Question number 1. Right. The company bought back 20,000 shares at rupees 30 each. This transaction in respect of the buyback was financed by sale of 4/5 of the trade investments for 6.2 lakhs. Show important accounting entries in the books of the company and to record the buyback and also the balance sheet after buyback. So you have to complete fully. Make it simple. Okay. Clear? The company bought back 20,000 shares at 30 each. What is the format here? Buyback share, premium on buyback, proceeds are transferred from free resource to CRR, and cross check what? Buyback share face value should be equivalent to proceeds and CRR. That's a cross verification. Means this proceeds and this amount should be equivalent to the face value of the buyback share. This amount is transferable to free resource. This is the loss transferable to the free resource. The company bought back 20,000 shares at rupees 30 each. Face value being 10. 20,000 into 10, 2 lakhs is the value here. 20 rupees is the premium. 20 into 20,000, 4 lakhs is the premium. 4 lakhs is the premium. The transaction in respect of the buyback was financed. How this is financed? By selling the investment. 450 investment sold for 620. We have investment being 450, 4.5. In that 4/5, 3,60,000 rupees worth investment sold for 6.2 lakhs with profit. Sale of investment. Balance 90,000 still available. Show important accounting entries in the books and then you have to prepare balance sheet, right? Very simple. Now, what happens? We don't have the proceeds. Okay, what about the buyback shares face value? 2 lakhs. Proceeds value being 0. Then what should be the CRR? The amount required for CRR being 2 lakhs. It should be 2 lakhs. That's all. Is that clear? Now come on, tell me. No entry for the issue. No entry here. Entry for issue is missing. And entry for buyback, 2 entries are there. One is for what? Due. Another one is payment entry. Due entry. Second one being payment entry. Third one, if you are paying more, then it's a loss. Adjusting loss entry. Okay, adjusting loss entry. And what about this one? CRR creation entry. 4 entries. Usually 5 or 6 entry. This is missing. And entry for sale of the asset. 6 entries. This is 5 entry. 1 entry is missing. So only these entries you have to master, then that entire content is over. I am going to pass all the entries here. Come on, tell me the entry for this. Equity share capital account debit. Okay, equity share capital account debit. Premium on equity share capital. Buyback. Debit. To equity shareholders. 2 lakhs, 4 lakhs, 6 lakhs. Here, equity shareholders account debit. To bank. You pay 6 lakhs. For the loss adjustment, you have to use any free resource. Securities premium is not the free resource. Then we have these two. Resource, revenue resource and profit and loss are being the resource you have. But for this purpose, you may be allowed to use the securities premium also. If you don't have the other option, you can use. Otherwise, you don't go with that one. You don't go with that. Now, how much is CRR to be created? 2 crores, 2 lakhs. From where? Here. So, the entry for this being revenue reserve account debit to CRR. How much is that? 2 lakhs, 2 lakhs. How much is the loss? 4 lakhs. This 4 lakhs can be adjusted in the revenue reserve itself. So, the entry being okay. The entry being, if you don't have any other option, you can use the revenue securities premium. If you have the other reserve, you can use it directly. So, revenue reserve account debit to premium. This third entry I may pass here. Third entry. Revenue reserve account debit to premium on buyback. How much is the loss? You pay 4 lakhs excess is the loss. And for sale of the investments, 5th entry, you collect the amount in bank 6.2 lakhs, but the investment value being in your books it is 3.6 only. You gained how much? 2.6 lakhs is your gain. 2.6 lakhs is your gain. Okay. Now I have to incorporate all these things in the main book. Main book. In the revenue reserve, we have securities premium untouched. Revenue reserve 7.8, you know. 4 lakhs debited. Another 2 lakhs debited. 6 lakhs debited. Hereafter, revenue reserve becomes 1.8 lakhs. I have not touched the securities premium, that remains as it is. In case of profit and loss on sale of the investment, we get 2.6 excess. Then what is the new value? 4.1 lakh. Equity share capital debited by 2 lakhs. How much is the equity share capital? 8 lakhs. In that 2 lakhs is debited, means now it is 6 lakhs. 6 lakhs. Premium on buyback debit, premium on buyback credit got eliminated. Equity shareholders credit, debit got eliminated. Bank debit 6.2, credit 6. Still I have 20,000 excess will be addable with the bank account. So 7, with that I add 0.2, so 7.2. 7.2. And in case of investment, 3.6 is eliminated. Now the new investment being the balancing figure 0.9 only. Remains this CRR unticked, and I'll tick and it will be posted as a part of resource and surplus named as CRR, this value being 2. So all the entries recorded in the balance sheet, now the total of the balance sheet here being, this one being 9.4, 9.4, this will be 23.4, this will be 17.2. So reserves and surplus as per the revised calculation 9.4, non-current liabilities remains as it is, current liabilities 5.2 remains as it is, non-current asset 23.4 and current assets being 17.2. Come on, get me the total of the balance sheet. 40.6, it is now agreeing, 40.6. That's all. Most often, you may be expected to answer only the journal entries. Okay, what journal entry? If there is an issue of shares, entry for issue of shares, and due entry, payment entry, loss adjustment entry, and creation of CRR entry. Rarely asset sale entry, loan borrowing entry may be passed, but cross verification is always done with this. This cross verification should always be done. If it is clear, text me. Now, let's see what are called free reserves. Reserves are profit available for the dividend distribution freely is called free reserves only. This will be named as CRR on redemption or buyback of shares. Redemption of preference share as well as redemption of buyback shares. Like general reserve, reserve fund, dividend equalization reserve meant for the distribution of dividend only, profit and loss account, any voluntary amount you created, all these things are example for the dividend divisible profit. Securities premium is not divisible profit. Forfeited share, if you are forfeiting amount without repaying, retained by the company is called forfeiture of share, also be non-divisible profit. Profit prior to incorporation also non-divisible profit, and capital reserve from forfeiture share also be non-divisible profit. Capital reserve from revaluation of assets also not divisible profit. Unclaimed dividend, if any, also be non-divisible profit. In your P&L account, if you are given these items, you cannot use it for CRR creation. Now, section 68 says what is buyback shares and how can be. Buyback can be purchased out of free resource, securities premium and profits. Means buyback shares can be done out of free resource, means fresh issue or free resource including securities premium. This securities premium can be used for buyback of equity shares, not for the preference share. Not for the preference share. Okay, these two. In that case, to that extent of free resource used, you have to create the CRR to the extent of nominal value of the share. That's why I told you face value of buyback share should be equivalent to profits and amount created in the name of CRR. You have to always cross verify. That's all. Why do you buy back? To increase the promoter's holding. So, for example, promoter and general public, out of 100 share, promoter holds 45 shares and general public holding 55 shares. Now, promoter cannot control, only general publics are controlling. Immediately, the company announces the buyback and asks him to sell their share. So, now around 25 shares bought back. Hereafter, promoter will hold 45, general public will now hold only 70. Now, promoter's shareholding being 45 out of 75. Am I right? More than 50%. Now, they can have the control over that. Earlier, it is 45 out of 100, then 45%, less than 50% control. Now, they get more control. That's an advantage to go for buyback. Increase EPS. Number of shares is decreasing, the EPS will increase. Target capital structure, share value, support share value will be increasing if the number of shares available in the market is lesser. So, these are some of the examples. Okay. Now remember, the most important point here is this one. How many shares can be bought back, sir? What is the condition for the buyback? Conditions. It should be authorized in article. You need to pass a special resolution. And it should be fully paid up shares. From the date of special resolution, within 12 months, it should be completed. These are the 4 conditions. What is the maximum number of bought back shares, buyback shares, sir? Whichever is lower of 3 level. Resource test, shares outstanding test, debt equity ratio test. Among the 3 tests, the least number can be bought back at any time. So, this is what about the condition. So, 2 aspects are expected in buyback. One is all about buyback shares calculation. Out of what? One is all about conditions and what is the maximum number of buyback. Question number 1 is all about buyback related. Question number 3 is all about maximum number of buyback. So, let's directly go for the third question. For that 3 conditions, number 1 being resource test, another one is share outstanding test, another one is being debt equity ratio test. Okay. If you have 100 shares, how many shares at a time you can buy back maximum, based on the number of shares? 25. Maximum number of buyback shares should be less than or equivalent to 25% only. After buyback, what could be the debt and equity? Debt by equity. If you have the equity being 100, debt being 50, then what about the debt equity ratio? 0.5, 50 by 100. If you have debt being 120, your equity being 120, your equity being 70 or 60. 60 means what happens? 2. Here the debt equity ratio is 0.5 only, you can buy back. Here your debt equity ratio is 2. If you buy back even 5 share, this becomes 120, this becomes 55. What about the new debt equity ratio? The new debt equity ratio is more than 2. Am I right? You cannot go for buyback. After the buyback, the debt equity ratio should be only 2 maximum. Less than 2, okay. Maximum 2. So, debt equity ratio should be less than or equal to 2 only after the buyback. So, here possibly already 2, you cannot buy back. Suppose if you have this being 70, how much can be bought back? 70, how much can be bought back? 120 means it is 2 share and it should be 1 share. 2 share 120 means equity should be 10. You can make the equity being 60. Already we have 70. To make it 60, you can buy back around another 10. Okay, so debt equity ratio after buyback should be 2. Next one being resource. Next one being resource. Resource is nothing but all the income, accumulated income all put together. After the buyback, the maximum buyback could be only 25% on the net investment. Equity share capital and accumulated profits and losses, add up all these things, maximum 25% on that can be bought back. That is called resource. 25% of the paid up capital and the free resource. You add the paid up capital and free resource, and that 25% can be bought back. That's a condition number 1. Or based on the number of shares, maximum 25% can be buyback. Or based on debt equity, maximum debt equity ratio should not go beyond 2 level. So you make it 2 level alone possible. Find out all these number of shares to be bought back under all the 3 options. Among the 3, lower will be taken. Let's now solve the last illustration, question number 3. Question number 2, where we have preference share redemption also. Actually, preference share is at the foundation level now, but anyhow, as there's a redemption of buyback, means buyback shares, usually they will try to include this one also. We'll see. I'll give the overall view about that. Let's now go for question number 3. Question number 3. Now, what happens here? Calculation of maximum number of buyback. Okay, question number 3. Question number 3. So, what you have to do? Number 1 being resource test. Number 2 being shares outstanding test. Number 3 being debt equity ratio test. 300 crores, 10 each. Then 30 crores. 30 crores. As per the resource test, how many shares can be bought back? 7.5 shares can be bought back. 7.5 shares can be bought back. Okay. The shareholders have recommendations of Board of Directors approved by its special resolution at their meeting on 10th April 2015. A proposal to buy back maximum permissible equity shares considering the huge cash surplus following account of one of its divisions. Huge cash is there. So they want to buy back. The market price was hovering in the range of 25, and in order to induce the existing shareholders to offer their shares for buyback, if I offer the same market price, no one is willing because already the same price is available in the market. So in order to induce them to sell their share, it was decided to offer 25% above the market price. 20% on this being 5. Now the buyback price is 30. Buyback price is 30. Advise the company on maximum number of shares that can be bought back and record journal entries. Okay, we'll see that journal entries later on. Journal entries is very simple. So our requirement is determine what's the maximum permissible buyback. 30. Net worth. What is the net worth here? What is the net worth here? Now, equity share capital, general reserve, securities premium, profit and loss. Export reserve being the statutory legal requirement, you have to use it or maintain it. You cannot use it. You cannot use it. Already told you, net worth means share capital and reserves for the owners, including securities premium for this purpose. Now, total this 720. Okay, 720 into how much you can bought back? 20%, sorry, 25%. 180. 180 crores can be bought back. 180 crores can be bought back. Clear? Now, what is the buyback price per share? 30. Using 180, if you are buying every share, you have to pay 30 rupees, means how many shares can be bought back? 6 crore. This is crore. 6 crore shares can be bought back. 6 crore shares can be bought back. So one is straight number of shares into 25%. Next one is net worth in that 25%. In net worth, you should not include any statutory reserve or revaluation reserve not in the form of cash. Not in the form of cash. Third one is debt equity ratio. In case of debt equity ratio, how to calculate? Very, very important. Very, very important here in case of debt equity ratio. Okay. As per the debt equity ratio, number of shares to be bought back here being, number of shares bought back being debt divided by proprietor's fund. Proprietor's fund. Proprietor's fund. Clear. Now, what is the loan fund we have? 800. What about the proprietor fund? Owner fund. Owner fund being this one. How much? 720. Okay. Now, what about the number of shares we bought back? That I am going to calculate. I am going to calculate that one. For buying every share, at what rate we are purchasing? 30 rupees, you know. I have to pay 30 rupees. 30 rupees will go off. 30 rupees into number of shares. 30 rupees and number of shares will go off. Okay. 30 rupees and number of shares. Otherwise, in this case, proprietor fund minus buyback payment. That should be subtracted. Not only that, if you are buying back the share out of free resource, you have to create what? CRR. For 30 rupees, how much a CRR should be created? For 30 rupees, how much CRR should be created? How much CRR to be created? Yes, tell me. CRR is created to the extent of face value. To the extent of face value. Okay. To the extent of face value. Is that clear? In this 10, face value being 10 and 20 being securities premium. If I create this 10 as CRR, your money blocked also not being your proprietor fund. So, minus 10 into number of shares. Minus 10 into number of shares. 30 rupees fund goes out. 10 rupees now renamed as a CRR is not being the proprietor's free reserve. 40 rupees has gone. Payment 30 goes out. 10 rupees still with you but named differently. Not considered as your equity. Not considered as your part of equity. So 30 and 10 both will be removed. Now find out the number of shares here. Should be how much? 2. Should be 2. The debt equity ratio should be 2. Come on, find out the N here. N here. So 800 is equivalent to 720. This will be multiplied with that. Then 1440 minus 80 N. 80 N. So N is equivalent to 1440 divided by 800. 80 divided, sorry, minus 800 divided by 80. Get me the value. Is it 8? Yeah. What about the maximum buyback shares? Lower of these 3. Clear? Clear? Only this calculation you have to be careful. Debt by equity should be equal to 2. Debt is given. Denominator equity, no. From the existing equity, subtract the amount payable for the buyback. Don't forget to subtract the amount converted into the CRR to the number of shares. The number of shares is going to be calculated. Keep this being X or N. Now, The last question. If borrowed funds were 1200 crores, rather than 800, if it is 1200 crores, borrowing being currently 800. If it is being 1200, what happens scenario? First two are same, only the third will be changing. I am going to use the same formula. What is that? Rather than numerator 800, it is 1200 divided by 720 minus 40n is equal to 2. Is equal to 2. Okay. Then the ultimate value here being 3. Then what about the maximum shares buyback? Among the three, whichever is lower. What is that? 3 crore shares only bought back. Clear? If the borrowing funds rather than 1200, if it is 1500, what happens? If it is being 1500, what happens? First two are same, but the last one is going to be changed. In numerator, debt being 1500, denominator 720 minus 40n is equal to 2. Now find out the n. Find out the n. Okay, then 0. You cannot make it 0, negative 0. So how much number of shares can be bought back? 0. Last option you cannot buy back. The last option you cannot buy back. Now they have asked the journal entries also to be passed. Journal entry. I'll go with the first model. First model. Buyback shares, premium on buyback, fresh issue, free resource to CRR. This will be adjusted in the free resource. Here, maximum 6 crores can be bought back. This is 10, this is 20. 6 into 10, 60. This will be 120. No free resource. So CRR should be 60. CRR should be 60, this amount. If you add up these two amounts, this should be 60. Now I pass journal entry for this. No journal entry. No issue. Second journal entry being due. For the due journal entry being equity share capital account debit, premium on buyback account debit to equity shareholders. This value being 60, 120, 180. Make the payment to them. Equity shareholders account debit to bank 180, 180. Now you have to pass the entry for this free resource. This adjustment. Free resource account debit or profit and loss account debit to premium on buyback. The value being 120, 120. Okay. Now finally, for this free resource account debit to CRR, the value being 60. Clear? With that, buyback share is over. I will just give the format for the redemption of preference share. But that will be applicable for the foundation only. Anyhow, at the inter level, you may be expected to answer that one also. I will give the format. I request you to go and see that video later on. Only these two concepts. One is passing the journal entry, another one is what's the maximum number of shares can be bought back. See, sometimes you may be asked to redeem the preference share also, though it's not related for CA inter. But a comprehensive illustration covers both put together in the same illustration. In that case, how can we do? Redeemable preference share capital. Are you paying any premium for that? Premium on redemption. How can you redeem? You can redeem out of proceeds from fresh issues or transfer from free resource to CRR. This premium on redemption, you know, can be adjusted by transferring to the free resource. Right, that's all. Always remember the redeemable preference share capital's face value should be equivalent to the proceeds as well as amount created in the CRR. Proceeds from shares, not debenture, not debenture. Debenture is not sell issue of shares. Only shares, equity shares and preference shares will be taken. Entry number 1. What is the entry number 1? Issue of shares. Journal entry being bank account debit to equity share capital. If you issue at premium, then securities premium account. Amount payable to them due entry. What is the journal entry? Come on, guess. Redeemable preference share capital account debit. If you are paying more than premium on redemption account debit, payable to whom? Redeemable preference shareholders. Next entry is all about what? Settlement entry. Redeemable preference shareholders account debit to bank. The next one is all about the loss. Okay. Free resource account debit. Free resource account debit to premium on redemption. Last entry. For the creation of CRR, free resource account debit CRR to CRR. Is that clear? 5 entries. 5 entries. One difference is there. Securities premium under this model cannot be used for this. But under this model, even you can use a securities premium. Free resource or securities premium can be used. And here, free resource or securities premium can be used. Securities premium cannot be used for the redemption of preference share case. Rest will be the same. See, here clearly stated. Buyback shares out of not only free resource, securities premium can also be used. If you go and see redemption of preference share where this securities premium is missing. Hope now you'll be able to understand this case. Yeah, the format is given for redemption of preference share. Redemption of preference share. One thing is there, securities premium cannot be touched, but it can be used for the buyback shares. Here also you can use the securities premium for buyback. Here also you can use the securities premium for buyback share. Rest of the things are same for both the model. Anyway, I request you to go and see a redemption of preference share from CA Foundation book. Okay, that video you can go and see.